Okay, let's move on to the next one, which is where we left off the last time. Hold on. Let me let me readjust again. Okay, chapter 8. Okay, all right. Now I got it. Okay. Let me change the volume. Okay. Okay, the last time that we stopped is on the capital asset pricing model. So what we are going to do here is that we are going to link between the asset pricing model as well with the security market line, okay, which is the last time we stopped at slide numbers around 74, okay. Here what it says, the depiction of the capital asset pricing model as a graph that reflects the required return in the marketplace for each level of non-diversifiable risk. Okay, so that is what the security market line does. It puts together all the companies with their own beta is under one chart, so you can see, you know, the level of risk of the company and how it equates with the required return. Okay. And let's have a look at this video here.
On an economics graph, the security market line shows market beta versus market return. Beta is a number that describes a stock's volatility or risk relative to the market. If a particular stock's value rises or falls at the same pace as the market, it has a beta of 1, which means average risk. If a stock's price changes more than the market's average price, it is more volatile, indicated by a beta greater than 1. Stocks with less price variation than the rest of the market are less risky, shown by a beta lower than 1. Typically, stocks with market beta higher than 1 offer greater returns than those with market beta less than 1. A security market line plots the average return for stocks that have a given value of beta, helping an investor determine whether an asset offers a reasonable expected return for its risk. General Flowers has a beta of 1, but pays a yield of 5%, which is higher than average. It will plot above the security market line. This means it is undervalued relative to its amount of risk. Similarly, if National Chairs Company has a beta of 1 but offers a yield of 3%, which is below average, it is likely overvalued because it pays less than average for its amount of risk.
Okay, so basically there's a security market line putting all the companies under the same line, under the same graph, with each respective beta, and how this beta reflect it with the required return. Okay, let's look at the explanation recording here. In the preceding example for Benjamin Corporation, the risk-free rate denoted by R subscript F was 2% and the market return R subscript M was 6%. We can plot the SML by using the two sets of coordinates for the betas associated with RF and RM. The beta for risk-free and beta for market. That is, beta for risk-free is 0, risk-free is at 2%, and when beta market is 1, the risk-free rate is at 6. Figure 6.9 presents the resulting security market line. The line has an intercept of 2%, meaning that a security with no risk earns a 2% return. The slope of the line is 4%, equal to the risk premium on the market portfolio, which is 6% minus 2%. The figure highlights that there is a trade-off between a security's non-diversifiable risk and its required return. Notice that asset Z, which has a beta of 1.5, has a required return of 8%. The SX risk premium is 6%, which is 8% minus 2%, which is higher than the market premium. The general principle illustrated in the figure is that the risk premium for an asset with a beta greater than 1.0 will be greater than the risk premium of the market, whereas an asset with a beta below 1.0 will have a risk premium that is less than the market risk premium. So what you can do is that you can see how's the beta of all the companies can line up here. Okay, usually it should be along this SML, the security market line. So meaning to say if it's 1.5, you expect the return for that stocks SXZ to be around 8%. Just now what we have seen here as depicted in the video is that whenever, let's say, you have a company has a beta somewhere around here, okay, the beta for that company is 1, but what the returns, when you assess it, the returns for the company is around 7%. If you were to look here as compared to the market return, okay, based on SML should be around 6%. So happens the company's beta is the same as the market return, market beta. So it's showing more than that, 7%. So based on the analysis, if investors were to look at this particular stock that somewhere it sits around here, but has a higher return than the market return, meaning to say the company is considered probably undervalued because it's given a higher return than what it's supposedly risk level at that particular time. And the same thing is that if another company might have a return of, let's say, around 4%, but the beta is around 1. So the return is lesser than the market return. So in that case, the investors can perceive the company is overvalued, meaning to say it's supposed to give a better return, but it is considered underperforming. You can say that, okay, much better word for it, which is underperforming before, and the other one is overperforming at its level of risk, signified by the beta. Okay, let's look at other things regarding this SML shift in the security market line. Okay, what does that mean here? Changes in the inflation rate. So what happened if there's a changes in the inflation rate? Okay, as we know that the risk-free rate as proxy or representative by treasury bill or treasury bonds, how we figure out our risk-free rate, I think you have already learned during the chapter on bonds and interest rates, where it would say that risk-free rate is a function equals to the real rate or purchasing power. Okay, you can see this like asterisk here plus the inflation rate. So the risk-free rate, okay, even the treasury bills will go up if the inflation rate goes up. You can see during the 1970s, but nowadays it has been quite very tame, the inflation rate, so more or less is around 3%. Changes in inflation expectation result in parallel shift in the SML, security market line. So what does that mean here? In the preceding example, using the capital asset pricing model, the required return for SXZ, RZ, okay, was 8%. Okay, for SXZ was the 8%, assuming that the risk-free rate of 2% includes a 1% real rate of interest and 1% inflation premium IP, then the equation 8.9 confirms that risk-free rate is 2%. So this is the base case. When the risk-free rate is 2%, the required return base, when we calculate using the CAPM model for SXZ, is around 8%. Okay, what if there's a changes here on the inflation rate? These numbers change. Now assume that the recent economic events have resulted in an increase of 3% in the inflation expectation, raising the inflation premium to 4%. Okay, so what we have here is that these numbers change from 1% to 4%, so the risk premium here changes. Okay, As a result, all return likewise rise by 3% in this case. Okay, so the risk-free rate, okay, it will change here. Okay, so it will change from 2% to 5%. Okay, because of raising the inflation premium to 4%. So these numbers here change from 1% to 4%. Okay, so it changes. So you can have incremental changes of by 3%. Okay, so so if you have 1% plus 4%, it becomes 5%. So let's look at the market rate. Okay, the market rate will also change by increase by 3%, 6% to 9%. So let's have a look there. You know what actually happened. Okay, then we look at the returns on ZAC asset. Substituting these values along with ZAC's beta of 1.5 into the CAPM model. So if you were to insert it, so we have the new risk-free rate plus 1.5, the beta for it, and the market rate has increased from 6 to 9%, minus 5% there. So what we have here, the new numbers here is around 11%. So comparing the returns for asset ZAC of 11% to 8%, we see the changes of 3% in assets ZAC required return. So equal change in the inflation premium. The same 3% increase result for all assets. So what happened here? So let's have a look. You know, it's like everything change, everything being shift upwards. The curve SML line shift upwards, so it affects every of those returns, where they are talking about risk-free rate, market rate, and also asset ZAC.
Figure 8.10 depicts the situation just described. It shows the 3% increase in inflationary expectation results in a parallel shift upwards of 3% in the SML. Clearly, the required return on all assets rise by 3%. Note that the rise in the inflation premium from 5% to 8% I to I1 causes the risk-free rate to rise from 2% to 5% RF, which is RF to RF1, and the market return to increase from 6% to 9%, which is from RM to RM1. The security market line therefore shift upwards by 3% from SML to SML1, causing the required return on all risky assets, such as asset ZAC, to rise by 3%. The important lesson here is that a given change in inflationary expectations will be fully reflected in a corresponding change in the returns of all assets, as reflected graphically in a parallel shift of the SML.
Okay, so that is the changes. So it affects every of the returns for all types of assets. Okay, if there's inflation changes. So inflation is like a systematic risk. You know, if there's a change, it affects everybody there. You know, nobody is what they call escape from that effect there. Okay, let's look at change in risk aversion. So what does that mean? The slope of security market line reflects the general risk preference of investors in the marketplace. If investors become more risk averse, then the slope SML becomes more steeper. So basically, if the returns required for that particular if the market returns increases, okay, if the market returns increases, because we know that the market over average return has a beta of 1, but in that sense the required return has increases, therefore investors are demanding more return for the same level of risk, okay, to invest in that particular market. Okay, so what will happen? How does it going to affect? So we can see here the changes.
In the preceding examples, the SML in figure 8.9 reflected a risk-free rate RF of 2%, a market return RM of 6%, a market risk premium RM minus RF of 4%, and a required return on asset ZAG of 8% with a beta ZAG of 1.5. Assume that recent economic events have made investors more risk averse, causing a new high market return RM1 of 9%. Graphically, this change would cause the SML to pivot upward, as shown in figure 8.11, causing a new market risk premium, that is RM1 minus RF of 7%. As a result, the required return on all risky assets will increase. We can calculate the new required return for asset ZAG with a beta of 1.5 by using the CAPM equation 8.8, which is RZ1 is equivalent to 2% plus 1.5 times bracket 9% minus 2%, close bracket, equals to 2% plus 10.5%, equivalent to 12.5%. This value appears on the new security market line SML1 in figure 8.11. Note that although assets ZAG's risk as measured by beta did not change, its required return has increased because of increased risk aversion reflected in the market premium. To summarize, greater risk aversion results in higher required return for each level of risk. Similarly, a reduction in risk aversion causes the required return for each level of risk to decline.
Okay, so there's a conclusion, the effect of if there's changes in the market, the returns on the market. Okay, so it will change the returns on the rest of the assets or debt securities. Okay, right. So I think that's nearly wrap up for the chapter on the risk and return. Some of the comments on the capital asset pricing model, something that need to take note. To estimate stocks, beta analysts generally use historical data. The estimates beta may or may not actually indicate the future variability of returns. Okay, so you can use the beta, but how good is the beta to estimate the future is something you need to be able to look forward, analyze it, and sometimes the changes in the company is very drastic. Maybe the beta cannot be used anymore, so you have to look how the company is doing right now as compared to how you expect the company is going to do in the near future. So the beta is as good as the formulation. So basically, you may need to make a little bit adjustment based on the beta if you feel the company is getting a little bit much riskier, and so you need to probably increase the beta for it. Maybe because your analysis is differ from the analysis being forwarded by other financial analysts. Okay, users of beta commonly make subjective adjustment to the historical determined beta to reflect the expectation of the future. Okay, so basically that's what I'm saying. You need to make adjustment. You cannot just say, okay, if this is a beta, I believe in this beta. But you have to use your own reasonable judgment to how far you trust the beta that is reflected or being forwarded by other financial analysts. Okay, their analysis is as good as what their information has. So if you have further information and you feel that your information is much better, then you can make a little bit more adjustment on the beta. The capital asset pricing model was developed to explain the behavior of security prices and provide a mechanism whereby investors could assess the impact of proposed security investment on their portfolio overall risk and return. So basically, in other words, when you were to choose a company, you would like to see, okay, if I choose this company with a beta of so and so, this is my expected return, and then you would use that return you put in the mix of your portfolio. Okay, so it becomes part of your portfolio. So it doesn't mean to say that when you assess a company, then you say, okay, I'm going to invest in this particular company regardless, and you don't have any portfolio. So what happened was that I already mentioned, if you just invest in one or two companies, that company can inherit some of those unsystematic risks. So there's more risk to it. So if you were to put in a portfolio, then you can able to diversify it, you able to minimize the risk. So the only thing that you're more concerned is only the relevant risk. So that's the reason why for professional investors, they try to create a portfolio which minimize the risk level at given the expected returns that they hope for. Studies have supported the CAPM's main prediction that stocks with high beta should have a high returns on average. So basically, studies have shown that high beta expected high returns, but there is a double-edged sword. If things are getting worse, if the economy turns sour, then their high beta would reflect a much lower returns than the lower beta. The CAPM also sees widespread application and corporation that use the model to assess the required return their shareholders demand. So basically, this is widely being used. Okay, it seems that this model works roughly, okay, in most of the shares. Okay, can be used in portfolio analysis, how to minimize risk as well as to maximize the return. Okay, I think that's all what we already covered in the risk and return analysis. There's more to it. If you were to take the corporate finance classes or investment class, it would give much more detail, especially investment classes on the portfolio analysis part. Okay. All right. So let's go on. Let me see. Let's go on. Let me see. Sorry about that. Usually I make a mistake here. I forgot to tick the sound. Okay. All right. Okay. Okay, we leave the questionnaires to the last point, okay, because I hope I can cover all the slides by then, okay. All right. Okay, let's look at the cost of capital, which is chapter 9. Okay, you need to cover for this session, which is chapter 9, cost of capital. What does that mean? Okay, let's go through the learning goals first. Understanding the basic concept of the cost of capital. Number 2, list the primary sources of capital available to the firms. 3, determine the cost of long-term debt and explain why the after-tax cost of debt is relevant cost of debt. So number 4, determine the cost of preferred stocks. Number 5, calculate the required return on company's common stock and explain how it relates to the cost of retained earnings and the cost of new issues of common stock. Okay, and number 6, we are going to look at weighted average cost of capital. Okay, so let's start with the definition first. What is a cost of capital? The cost of capital here, it says, represents the firm's cost of financing. Okay, represent the cost of financing and the minimum rate of return that a project must earn to increase the firm's value. So the whole essence of this particular chapter is to understand, to measure the cost of financing so that it can be used to evaluate a project, okay, or meaning to say that that is the lowest return. Once you know what is the cost of financing that is available to you, then you can use the cost of financing 8%, 10%, 50%. That's your cost to evaluate a project. So the project that you are going to get into need to get a much higher return than the cost of capital that you have. Okay, so we look more detail in later in the following slides. And then what is capital? A firm's long-term sources of financing, which include both debt and equity. So capital is like a fund. So it can any type of source of money or funding. So we consider it as a capital. And then what's a capital structure? A capital structure is a mix of debt and equity financing that a firm employs. So meaning to say, how are you going to acquire the capital? Are you going to use the same proportion of debt, or are you going to use the same proportion of issuing shares or using some type of equity? Okay, so the mix of how you're going to source the financing, we call it the capital structure. And then the final one in the later slide, we are going to figure out what is our weighted average cost of capital, the WACC. A weighted average cost of a firm's cost of debt and equity financing, where the weights reflect the percentage of each type of financing used by the firm. So at the end of the day, you need to figure out, okay, if what is your average cost of capital. So the average cost of capital going to measure as a weighted average cost of capital. Okay, so that's the gist of what we're going to go through. So if you were to look at these companies here in 2017, you get Alphabet. Basically, it's the mother company for the Google. Okay, so in terms of the debt, this is their capital structure. Okay, this is their capital structure. So it mostly comprises debt and equity. Okay, so Alphabet is a Google, so they only have very small debt and they've got lots of equity. They are very cash rich, this company. Okay, and then you have the rest of other companies here, followed by Johnson & Johnson, Procter & Gamble, and these are like the old-timers companies. Alphabet is very young company relatively to the rest. If you were to compare, especially the dominant major companies that has been the bedrock of US companies, corporation, reflected in General Electric and General Motors. Okay, and these are the traditional companies. They have 50% of debt and the rest are equity. Okay, but the newer companies, the new tech companies, they have lesser debt and they have more equity. So which one is good? I think I would prefer less debt and more equity. So basically, okay, most of these companies, they're very mature companies. They're not really growing that much. You can expect the prediction, and more or less that is the way how their capital structure works. Okay, all right. Okay, let's look at it's two scenarios. A firm is currently considering two investment opportunities. Two financial analysts working independently of each other are evaluating these opportunities, assuming the following information about investment A and B. So the firm thinking of investing in A or investment B. Okay, so what happened here is that for investment A, the cost of investing is 100,000, and the lifespan for the investment is for 20 years, and the expected return is 7%. So what we have here is the returns from this investment is 7%. The analyst studying this investment recalls that the company recently issued bonds paying a 6% rate of return. He reasons that because the investment project earns 7% while the firm can issue them at 6%, the project must be worth doing. So he recommends that the company undertakes the investment. So meaning to say the cost of financing this this particular analyst find that in order to finance this project, the company can issue bonds, and the cost of issuing bonds is only 6%. So since the return from this project is higher than the return from the cost of financing by issuing bonds, so the analysts find that and making recommendation to go ahead with the project. But then let's look at the scenario B. Okay, another analyst looking at another project. The cost is 100,000, more or less lifespan is 20 years, but the expected return is 12%. The analyst assigned to this project knows that the firm has common stock outstanding and the investors who hold the companies a 14% return on their investment. The analyst decide that the firm should not undertake the investment because it produces only 12% return, while the company shareholders expect a 14% return. So happened was that assuming that the next cost of funding, okay, because they already depleted using issuing bonds, and the next source of funding is that by issuing shares. But if they were to issue shares, the required return from the shareholders expected from the shares that being issued is 14% return. But then based on the analyst evaluation on this project, the expected return is 12%. Given the fact that the expected return is less than the cost of financing by issuing shares, the analysts come up with the decision that should not go ahead with the project because the expected return is less than the cost of financing. So we get two dichotomy, two vision. So in this example, each analyst is making a mistake by focusing on one source of financing rather than on the overall financing mix. So what if instead the analyst used a combined cost of financing? So what if they were to use combined costs? By weighing the cost of each source of financing by its relative proportion in the firm's capital structure, the firms can obtain a weighted average cost of capital. That's what we call it, the acronym for it, WACC. So what does that mean? Assuming this firm desires a 50-50 mix of debt and equity, the WACC is 10%. So how do you get that? Is that 50% times the cost of the initial funding using debt plus 50% the cost if you were to issue by equity, 14%. So you get 10%. With this average cost of financing, the firm should reject the first opportunity, which is only given a return of 7%. Therefore, since it's given, accept the latter one, which gives a return of 12%, which is much than the 10%. So you can see that you need to use a much more holistic approach rather than just take like a piecemeal approach where, okay, this is the debt that the source of financing that we have. Debt, you go by debt first and then only by equity. You don't look at the overall. So here, by using the weighted average cost of capital, we can make the right judgment, and therefore we are not rejecting the one that gives a higher return, and also we don't accept those that gives a lower return. So make sure that at the end of the day, the correct call is being made. Okay, let's look at the video on this, on the cost of capital, how we do the evaluation here.
Cost of capital is the cost of funds used to finance a business. Typically, corporations obtain financing through a combination of issuing equity in the form of shares and by taking on debt through borrowing from banks or issuing bonds. The people who provide a company with its capital also want to earn a return on their investment. Combined, those factors comprise a company's overall cost of capital. The cost of debt is the interest a company pays. The cost of equity is the compensation investors demand in exchange for owning a company shares. The overall cost of capital is the weighted average of a company's capital sources, also known as the weighted average cost of capital, or WACC. The cost of capital is used to discount future cash flows from potential projects and estimate their net present value. Companies want an optimal financing mix. Debt has tax advantages over equity financing, but too much debt results in high leverage, leading to high interest rates to compensate lenders for the risk of higher default. Earns by using its capital, it's a good investment. If the capital needed to make money exceeds the amount of money the capital will generate, it's a bad investment.
Okay, so that's the reason. What is cost of capital is all about. You just have to use the right mix so that you can try to can get the correct cost of capital. Okay, then only then you use that to evaluate the project. So where do we get our source of capital? So we can get from several factors. One is from debt, using long-term debt, and then we can use from preferred stocks if the company does issue the preferred stocks, or can use from the common stock and retained earnings. So it says that not every firm will use all of these financing sources. You can use mix and matches any one of them. As far as retained earnings are concerned, is considered an opportunity cost, because retained earning is basically undistributed profit, the profit that company earns, but they are not giving out to the shareholders as a dividend, because they feel that they can use for better purposes for investment. That's the reason why they retain it. The flip side of it is that if they don't use for retained earning, might as well they give it to the shareholders, and shareholders able to make use for other investment, make use better of the capital or the funding that they have. So it's an opportunity cost. So you need to also evaluate it, because it's not free. Okay, it's not free, even though the profit comes from the company to use for other investment. So how do we evaluate? We are going to evaluate more or less like how we evaluate if the company were to issue new shares. Okay, some of the terms here, the financing cost associated with new funds, cost of long-term debt is the financing cost associated with new funds raised through long-term borrowing. Okay, so that one we know by issuing bonds. Okay, and or sometimes companies, they also they borrow money from the banks, but here we are looking more specifically on issuing bonds. And then we have other costs that entails, okay, when we issue new securities, which is the net proceeds. The funds actually received by the firm from the sale of a security. Sometimes when the company were to issue new shares, new preferred shares, or new bonds, they have to discount the bonds or the shares, because probably the receptivity of the market towards the price of the bonds or that security at its par value, they are not going to receive that well. So you need to discount it so that more customers, more buyers will purchase that security. So you need to figure out based on the net profits. And then the other miscellaneous costs, which we consider as flotation costs, which are the total costs for issuing and selling securities. So this cost is like when you issue new securities, you have to hire investment bankers, then there's a cost to it, and cost of issuing, administrative costs, all the postages and all those the costs, mailing costs, and the marketing costs, everything includes. So that is the cost, and you kind of express it per security, per share, or per bond. Okay, let's look at the example 9.2 here. Duchess Corporation, a major hardware manufacturer, is contemplating selling 10 million worth of 20-year 6% coupon bond, each with a par value of around $1,000, because bonds with similar risk earns return equal to 6%, Duchess bonds will sell in the market at par value, and they will have a yield to maturity equal to the coupon rate. Okay. However, Duchess will incur flotation costs equal to 2% of the par value of the bond, which is the flotation cost being calculated 2% times its par value, or $20 per bond. So the net proceeds to the firm from the sale of each bond are therefore $980. So meaning to say that Duchess wanted to issue new bonds, okay, but they cannot. When they were to issue new bonds, okay, these are the terms, and the bonds amount is 10 million, but it issued at par value of $1,000 with 6% coupon rate, and the length of the bond is for 20 years. Okay, but it has when Duchess Corporation issue, it has to incur flotation costs, and it eats up on the amount that Duchess able to issue. So the cost to it is $20 per bond. So the net proceed, okay, is around $980. Okay, so the net proceed of it is, so it becomes the yield to maturity. Okay, so in other words, what is saying here is that the yield to maturity is basically telling how much is the return the bondholders are getting. Okay, the real return. Of course, they are getting a 6% rate on the coupon, based on the coupon rate, but because of there is a cost to it, okay, Duchess are not getting the full they are not enjoying the they are not paying just at 6%, but they are just paying much higher, okay, reflecting yield to maturity, because they have to incur the extra cost, $20. Okay, so saying again, they are issuing at $980, okay, per bond, but at the end of the term, 20 years, not only they have to pay 6% rate every year, but they have to pay the principal amount at the ending of the 20th year, which is $1,000 per bond. Okay, but when they issue, they are getting only $980 per bond. So as a result, okay, what we are looking here is that we are looking the before tax cost of debt. RD is simply the rate of return the firm must pay on the new borrowings. Okay, so here we are looking at the yield to maturity, calculating the cost. Managers can calculate the cost of debt associated with a particular bond issuing by calculating the bonds to yield to maturity. So that's what we are trying to do. Okay, let's look at how you look at the actual yield of the bond before tax. Okay, before tax. Okay, let's look at the example here.
In the preceding example, Duchess received proceeds of $980 by issuing a 20-year bond with $1,000 par value and a 6% coupon interest rate. So Duchess can determine before tax cost of debt by finding the yield to maturity, which is the discount rate that equates the present value of the bond outflow to the initial inflow. So what we're going to do is that we are going to figure out what is the yield to maturity. We're going to input the present value as $980, which is the issuing of the bond discounted at $20, and the period is 1 to 20 years, and the coupon rate is 6%, so it's going to be $60 every year, and the par value at the end of the year, at the end of the 20th year, is $1,000. So if you were to do it, first of all, we clear it, make sure it's once per year. Then we just click the $980, which is the present value. We put a minus first, PV 20, and then the payment is 60 PMT, and the par value is 1,000. That will become the future value, and then we press the I. So we get the yield to maturity for the bond is 6.18%.
So the yield is around 6.18%. Okay, so in other words, the bondholders are getting a return of 6.18% before tax. The other way of how we can use it, that we can use using this approximation formula on the yield to maturity. Okay, so so RD is a return on the debt, is RD. Okay, so you have I stands for annual interest in the dollars, which is the coupon payment, 1,000 minus the net proceed from the sales of the bond, and then okay, and here is the number of years to the bond's maturity. Okay, let's see how it is being applied here. Okay, go.
Substituting the appropriate values from Duchess Corporation example into the appropriate formula given in the equation 9.1, we got the answer as 6.162. So basically what we are doing is that we are just plugging in I is the coupon rate, which is $60 I, and then 1,000 minus N is the actual proceed of selling the bonds, which is $1,000 minus the $20 discounted. We got $980 divided by the N is the period, and then N here again is a $980 plus 1,000 divided by 2. So all in all, we got around $60 plus $1 and 990, and the end result is 6.162. This approximate value of before tax cost of debt is close to 6.1177%, but it lacks the precision of value derived using the calculator.
Okay, so basically what we get is we kind of rounded up just now 6.18%, but it's, using this formula is quite close, 6.162%. At times it can be very close, at times it can be quite a little bit far off, but the recommendation is that you know, as best as possible you use the financial calculator. Okay, so what does that all this entail? Okay, let's have a look at it here. Cost of long-term debt. Okay, then we talk about what is after-tax cost of debt.
After the tax cost of debt, the interest payment paid to bondholders are tax deductible for the firm. So the interest expense on the debt reduces the firm's taxable income. So the actual after-tax cost of debt is the cost of debt, RD, times Y minus T, which is T is the tax rate. So Duchess Corporation has a 21% tax rate. Therefore, using the 6.177% before the tax debt cost calculated above and applying to equation 9.2, we find an after-tax cost debt of 4.88%, which is 6.177% times 1 minus 21% tax rate. Recall that when bondholders purchase a Duchess bond at par value, they expect to earn a 6% yield to maturity. Incorporating the issuance cost and the tax benefit of debt, the firm's after-tax cost of debt is just 4.88%, quite a bit less than the 6% return offered to bondholders. In most cases, debt is the least expensive form of financing available to a firm. Debt is a relatively inexpensive form of financing for two main reasons. Firstly, debt is less risky than preferred or common stock. That alone makes debt a low-cost form of financing because investors accept lower returns on bonds than on stock. Secondly, the firm enjoys a tax benefit from issuing debt that it does not receive when it uses equity capital.
So basically here companies, they prefer, at times they prefer to issue debt, because debts in general, the cost of financing is much lesser than common stock. And also on top of it, they are able to enjoy tax deductibility, because we need to understand is that the interest expense is part of the expenses in the income statement, so it's subjected to tax. So when you calculate it, the effective rate, okay, because of the tax deductibility of it, in other words, interest expense, it lowers the income. So when you calculate the tax on the lowered income of it, so you are paying less tax. So because of that, when we were to because of that, we find that as a result, the effective rate that the issuer or the bond issuer issues is not at 6.8%, not the yield 6.8%, even though they lose because of the cost of financing. You know, the what called the net proceed is because of the cost of the flotation cost, but they benefited more from the tax deductibility effect, in which the real cost is only 4.88% rather than 6.18%. Okay, but the disadvantages of debt is that they cannot issue too much debt, because otherwise the investors or those bondholders will get jittery, because they are not so sure whether at the end of the day they will receive the interest payment when it comes due. Because as you know that interest payment is an obligatory, the company has to pay it on time. If the company doesn't pay on the designated time, then the investors or the bondholders can demand and bring it to court, and they can be sued, and eventually if still they cannot make the right payment, the timely payment, they can be declared bankruptcy. So that is the disadvantages of it, okay, for issuing debt. Okay, let's move on to the next one. Okay, this one is more or less the same thing. I can just skip this one here. Okay, let's just look at the cost of debt in general. Okay, what's the cost of debt here?
Cost of debt is the interest a company pays on its borrowings. It is expressed as a percentage rate. In addition, cost of debt can be calculated as a before-tax rate or an after-tax rate. Because interest is deductible for income taxes, the cost of debt is usually expressed as an after-tax rate. The formula for the cost of debt is the sum of the risk-free rate plus the credit spread times 1 minus the tax rate. Different factors affect the different components in the formula. Fluctuations in the economy affect the risk-free rate. The amount of the company's borrowing and the credit rating affects the credit spread. This is because more debt and lower credit rating means a greater chance of default and thus more risk. The higher the default risk, the more lenders will charge to loan money. Government policy affects the tax rate. Assume Bilco Incorporated has a current credit spread of 3%. If the risk-free rate is 2% and the corporate tax rate is 35%, then Bilco's before-tax cost of debt is 5% and its after-tax cost of debt is 3.25%. If the economy slows, Bilco's cost of debt will be affected. If Bilco has to incur more debt to keep operating, its credit spread will increase. If the government raises tax rates to maintain tax revenue, that will also affect Bilco's cost of debt. Assuming Bilco's credit spread increases to 5%, the risk-free rate goes to 4%, and the government raises the tax rate to 40%. These rate changes, resulting from a slow economy, will cause Bilco's cost of debt to rise to 5.4%.
Okay, so this, okay, all right. So what it's saying here is that, like in this case, Bilco is not issuing bonds, is borrowing money from the creditors, from the bank. So basically that's what you have this credit spread, more or less. It's like the interest is like a coupon rate that they're paying. Instead of the coupon rate, they're paying the interest rate on the banks, and they are being measured by the risk level there, and the risk level is also being measured by the credit spread. Okay, but anyway, what we are looking is that we are just looking at the before tax effect and after the tax effect on the rates. Okay, let's look at the other one here. If the company were to issue cost of preferred stocks. Okay, when companies issue a preferred stocks, the share usually pay a fixed dividend, okay, and have a fixed par value. Okay, usually the meaning is to say the share price for preferred shares or preferred stock didn't change a lot. Okay, so the cost of preferred stocks or the returns that you're getting from investing in preferred stock basically is D. D doesn't change. D is the dividend. So if you were to invest in the preferred stocks, the dividend you're going to receive is the same throughout the year, divided by P. Okay, P is the price of the preferred stock. It's going to the same throughout the year also, over the years. But then here is being substituted by N. So what is N stands? Net proceed from the sale of the stock. So whatever sale, the stock price that you sell, then you have to incur all the costs. So you're looking at the net effect of it again after you minusing the cost. So the example that we have here is Duchess Corporation is contemplating issuance of 8% preferred stock. They expect to sell at par value of $80 per share. The cost of issuing and selling the stock will be $2.50 per share. So when we apply to the formula here, we got the cost of issuing the preferred stocks is around 8.25%. Okay, even though the dividend cost is around 8%. Okay, so what do we mean here? So the result here, because the dividend here is expressed as against the percentages against the share price, 8%. Okay, at 8% of $80, 8% of $80. So that's the dividend they're going to pay over time, which is around $6.40. And then when they issue the preferred stocks, they are getting only $77.50 out of $80 that they are supposed to get. Okay, so basically if you were to minus the cost of it, which is $2.50 from $80, you're getting only $77.50. So the overall $6.40 divided by $77.50. So the cost of preferred stock is 8.258%. Okay, let's look at the cost of common stock or cost of equity. All right. What's the background? Can you turn on? Hello? Okay, this okay. All right, finding the cost of common stock equity. Cost of common stock equity is and the other one, cost if you were to issue new shares. Okay, so what is telling here is that we are going to use the same formula for calculating the cost of retained earnings as well of cost if you were to issue the common stocks, but we are going to make a slight adjustment. Whereas the calculating the cost for required return, there are not going to be any of these administrative or flotation costs incurred, because we are just going to dip and use our own retained earnings or retained profit, okay, as opposed if we were to issue the new shares. Okay, let's have a look. What does that mean? Finding the cost of common stock. The cost, so what we are going to use is that we are going to use based on the formula being used, which is constant inflation, or the Gordon growth model, which is P0, the price of the share, is equivalent to the expected dividend next year divided by R, which is the return from the stock, minus the G, which is the growth rate on the dividend. So when we to reformulate the formula again, so the returns is basically D1 divided by the price of the stock plus the G. So so the cost of common stock is the cost of growth valuation model. Solving the R results in the following expression for the required return on the common stock. Okay, let's look at the example here. Okay, all right. Duchess Corporation wishes to determine the required return on its common stock. The market price P0 of its common stock is $50 per share. Duchess recently paid $3.80 dividend. The company has increased its dividend for several consecutive years. Just 5 years ago, the Duchess paid a dividend of $2.98 on its common stocks. Cost of equity. Okay, we take it as a general first. Okay, we call it common equity. Okay, so the formula here is R equals to D divided by P plus G. So here there is no flotation cost being considered yet. Okay, so R is equals to D1 divided by P plus G. And what we have to do is that we have to figure out what is the G, and we have to figure out what is the D1. Okay, so how we figure out, let's just bring our own calculator here. You can see the calculator here. All right, so if you were to use a calculator here, all right, so what we wanted to find is find the G first. The G is based on the growth of the dividend. Previously, the 5 years ago, the dividend was $2.98, and right now it has grown to $3.80. And we like to see what is the compounded growth over the period of 5 years. So what we do is that we just take $2.98 minus, and then we press our PV, and then the $3.80 becomes our FB, and then we're looking at 5 years, 5N, and then we press the interest rates, and that will give us the growth rate on the dividend is around 4.98, which is close to 5%. And then we have to know what is our D1. Our D1 is that we know that the company recently paid around $3.80, so 3.8 times 1 plus G, which is 1.05, so we get roughly around $3.99 here. So you get the required return to issue common stock equity, okay, is if you were to plug all these numbers together, is 12.98%. Okay, and then let's look if we were to use another way of how to calculate the cost of common stock equity. We use the capital asset pricing model. So so here we have to know some of the variables here, which is beta. We need to know what is the required the market rate, and also the risk-free rate, to know what is the return for that particular common stock equity. This is okay, all right. Okay, let's have a look here. Duchess Corporation now wishes to calculate the required return on common stock RS by using the capital asset pricing model. The firm's investment advisors and its own analysts indicate that the risk-free rate is 3%. Okay, you are already able to gather it. The beta is 1.5. The market rate is 9%, and then you plug everything here together, you get around 12%. Okay, here using CAPM model, the return for common stock equity is 12%, and using the Gordon growth model is somewhere around 13%. Okay, so that's what we got here. So the conclusion here is that notice that this estimate of the required return on Duchess stock does line up with growth. Gordon growth model is 13%. This is expected because the two models rely on different assumptions. In practice, analysts of Duchess might average the two figures to arrive at a final estimate for the required return on the common stock. So it depends, which one is the better one to use, whether you use the CAPM model or you use the based on the Gordon or the constant growth model. Okay, it depends on you yourself. You as analyst, if you much more comfortable to use the CAPM, then you can use the CAPM. It's the way how reliable these models have shown previously. Okay, so but if you are 50-50, you can just take those two numbers and then average it out. Okay, as what suggested here. Okay. Okay, the distinction here, okay, just go much more detail here. The CAPM technique differs from the constant growth valuation model in that it directly considers the firm's risk as reflected by the beta in determining the required return on common stock equity. Whereas the constant growth model, which is the Gordon model, does not look at risk directly. It uses an indirect approach to infer what return shareholders are expected based upon the price that they are willing to pay for the stock today, given the estimate of future dividends. So they use a different indicators. So they come up with, of course, different results. So it depends, which numbers or which indicators or variables that you are much more comfortable, which you rely upon. So that's what I said, is either one can be right. It depends on based on how comfortable are you. Okay, okay, just now when we talk about the cost of common stock equity without the flotation cost, basically we are actually the cost of retained earnings. But if there is a flotation cost, okay, then we are talking about more towards the cost of issuing new shares. Okay, so here what we are looking here is that when you issue new shares, you have to include some of the flotation costs. The cost, you have to hire investment banks. You have to pay for the filing registration with the Security Commission whatsoever. You have to pay for all those marketing costs, again, for the issuing, all the postage costs, and so on and so forth. So therefore you need to modify on the formula, so you have this net proceed here. Okay, all right, okay, let's write this example here. In the constant growth valuation example, we found that Duchess Corporation required return on common stock is 13% using the following values: an expected dividend of D1 $3.99, current market price P0 of $50, and expected growth of dividend of 5%. Okay, let's say that the company wanted to issue a new set of shares. To determine its cost of new common stocks, Duchess Corporation has estimated on average the new shares can be sold for $48. The Duchess shares will be underpriced by $2 per share. A second cost associated with new issue, flotation cost of $1.50 per share, that will be paid to issue and sell the new shares. The total underpricing of the flotation cost will be $3.50, meaning to say it's result of $2 plus $1.50. So those are the costs entails in issuing new shares. So if you were to do that again, we know that the dividend expected next year is going to be the same as we already calculated just now. It's just that we need to make changes on the next net proceed, which is basically the current price of the shares minus the what we call underpricing of flotation costs. Okay, underpricing refers to the discounting. What it does is that it discounts by $1.50 and the flotation cost by $2, so it becomes $3.50. So you take that number and you minus from 50, you got those numbers there, and therefore our conclusion here is that Duchess Corporation cost of new common stock is therefore between 13 and 14%. So in other words, the cost of issuing new shares is around 13.58%. And if we were to look, if we were to use when the company, if it were to issue to use from the retail earning itself, the most it only have to pay around 13%. The reason why the 13% because it doesn't have to incur any additional costs as compared to issuing new common stocks. Okay, hold on one second. Am I skipping anything here? No. Okay, so in a nutshell, what is it? Cost of retained earnings are the returns, the returns for the retained earnings. So R here is supposed to be a small subscript here. The cost of retained earnings is equal to the required return on the firm's common stock. So basically, the gist of what we are doing here is that when we calculate the retained earnings, we are calculating the cost of common stock without excluding all the flotation costs. Okay. All right. Yeah, I think I've already mentioned that. All this here. Okay, let's look at the cost of equity. Okay, from the perspective of the video here.
The cost of equity is the rate of return an investor requires from a stock before exploring other opportunities. Companies have to reward shareholders for the risk that other investments will pay a higher return. Typically, the cost of equity is higher when the overall stock market is strong or when the company is seen as volatile. The rate of return that investors seek may come from two possible sources. In some cases, they receive dividends, which provide an immediate reward for their ownership, or the stock could experience appreciation, enabling them to profit when they sell shares. Cost of equity equals dividend payout divided by share price plus rate of appreciation. Andy is considering an investment in Bubbly Fresh Beverage Company, a financially stable business whose stock is trading at $10 per share. Due to a robust economy, Andy is looking for relatively low-risk stocks that provide a return of at least 15%. With an estimated annual dividend of $1 per share, or 10% of the purchase price, the stock will need to appreciate by 5% a year in order to meet his cost of equity criteria. Of course, the challenge is that an investor can never predict the exact return of a stock ahead of time. The best they can do is provide an educated guess based on past financial performance, overall economic trends, and other factors.
Okay, so there's another side of looking at the cost of equity. Okay, let's look at the final wrap here. We are looking at weightage average cost of capital. We need to evaluate the average cost of everything here. So how we are to do that, we take the weightage of the debt, proportion of debt that we are going to use. We are taking the after-tax cost, okay, plus the weightage of the, if we have the preferred stock, we take as what it is, and the weightage of the common stock equity, whether we want to use based on the, what we call, new shares, or we wanted to use based on the retained earnings. It's either or, okay? All right. So here in the earlier examples, we found that the cost of various types of capital for Duchess Corporation, after tax cost of them is 4.8%. The cost of preferred stocks is 8.26%. The cost of the retained earnings. Okay, here we are talking about retained earnings because it's 13% based on the constant growth model calculation. As you know that the debt is the least of all these three. So Duchess has a total capital market value of 1 billion. The market value of firm's outstanding long-term debt is 400 million. The value of preferred stock is 100 million, and the market value of common stock is 500 million. So the overall capital structure is something like this. Okay, out of 1 billion, these are the amount of debt that the company issued in order to finance it. The whole asset of the company, 100 million is preferred stock, and 500 is the common stock. So let's look at the weighted average of capital. So from this weighted average, we can find out the proportion of it, which is 40% is considered using debt, which is 400 million divided by 1 billion. Preferred stock is 10%, common stock is 50%. So everything will come out as a as 100%. Okay, so so here what we can do is that common stock equity, we can have the retained earnings as well as the shares that are still outstanding, that is in the circulation. Okay, let's look at the weighted average cost of financing, how the company is going to calculate it. So based on that, we just times it up. So the long-term debt, the proportion of normally the whole company, the way how it's being financed using debt, 40% times the cost of it. Average cost of it issuing bonds is 4.8%. The effective rate is 4.8%. So the weighted cost is 1.95%. So we do the same for preferred stock and we do the same for common stock. So that's how we got the weighted average cost of capital financing for the company is 9.28%. In other words, the company, in order to, in general, to invest in new projects, they will use this as their general cost of capital as a benchmark for them to make new investment, or if they were to seek for any returns, all the returns has to be much bigger than the weighted average cost of capital. Okay, so in the nutshell here, because the firm expects to have a sizable amount of retained earnings available, it plans to use the required return on equity or from the retained earnings as the cost of common stock equity. The calculation for Duchess Corporation appears in table 9.2, which comes as 9.28%. This establishes a hurdle rate. So we consider it as a hurdle rate, meaning the company should accept the investment opportunities that promises returns above 9.28%, as long as those investment opportunities are not riskier than the firm's current investments. So given that the risk level is reasonable enough, the company, in order to seek for investment, should look any returns that is greater than 9.28%. Okay, so here we are using, when we do the analysis, we are using based on the market value. Okay, meaning to say, measure the proportion of each type of capital in the firm's capital structure. In calculating WACC, market value weight should be used rather than book or par value. We are losing when we look at the stocks. The cost of equity, we are using the price of the current price of the market, and when we look at bonds, we are looking also at the current bond pricing. Okay, let's look at the slide here to wrap it up, what we have already learned for today.
Weighted average cost of capital, WACC, measures a company's cost to borrow money given the proportional amounts of each type of debt and equity a company has taken on. A company's debt and equity, or its capital structure, might include common stock, preferred stock, and bonds. WACC is used internally by a company's management as part of determining whether it would be profitable for the company to finance a new project. It is also used by investors as one way to value the company's shares and decide whether to invest. The higher the WACC, the less likely it is the company is creating value because it has to overcome more expensive borrowing costs in order to make a profit. Mary is considering an investment in John's Gyms. She determines that the company is producing a 10% return and calculates that the company's WACC is 8%. By subtracting the WACC from the return, she sees that for every dollar John's Gym spends, it creates 2 cents of value. If John's Gyms had a WACC of 15%, it would be destroying 5 cents of value for every dollar it invested. If its WACC were 10%, the company would be neither creating nor destroying value, but remaining stagnant. Mary thinks she might pass on this investment because while the company is creating value, it's not creating as much as she'd like to see. However, WACC is just one of several tools she uses to evaluate her potential investment.
Okay, so that's how they use the WACC. The word WACC looks very weird here. The term that being expressed. Okay, so WACC. Okay, let's look again and for another slide, how we look at required rate of return as compared to WACC.
Investors use the required rate of return to decide where to put their money, and corporations use it to decide if they should pursue a new project. It factors in risk and specifies the minimum an investor should accept. Its uses are wide, and it considers several factors. One important use is in discounting many types of cash flow models. It can be used to calculate the present value of dividend income, or the present value of free cash flow to equity, or the present value of operating cash flow. Equity, debt, and corporate expansion decisions come down to measuring the cash received against the cash paid. The required rate of return can provide such calculations. A stock's return equals the excess return for a given level of risk plus the stock's beta times the return expected from the market. Another use is the dividend discount approach, which provides a model for determining the intrinsic value of a stock based on a future series of dividends that grow at a constant rate. The required rate of return would be the dividend payment divided by the stock's current value plus the growth rate of the dividend. Investment decisions in corporate finance come down to the weighted average cost of capital. To find the weighted average cost of capital, take the weight of the source of financing and multiply it by the corresponding cost. There's one exception. Multiply the debt portion by 1 minus the tax rate.
Okay, so that's how you reconcile. Basically, the required return is more or less the WACC. So you have to take the average cost of how you get the source of financing, and then in order to evaluate for any investment or any project, you can use that as a benchmark, okay, as a general benchmark. Sometimes in new projects, if it entails a much riskier project, probably what you can do is that you can add a further premium to the cost of capital. Maybe you can entail that if your cost of capital is, most of them is around 11%, and if you want to engage in any risky project, maybe you can add another premium of 3 or 4% to it. Okay, so you can use it as a guideline in your investment. Then you can evaluate whether the project is worthwhile or not, okay, to go in. All right, so I think that's a wrap for the whole chapter here. Okay, so there's not so difficult, very straightforward chapter here. Okay, hold on. Right, okay. Let's see what the. All right. Okay. For the slides, I think I've already put up there in the what do you call, in the spectrum. Okay. I think there's a request for it. Okay. All right. Okay. So any general questions? Okay, if there's no general questions, okay, for the questions on the on the case study, you can ask during the tutorial session for the project. No, for the project you can ask during the tutorial sessions, and okay, you can have further discussion during the tutorial about this subject matter. Okay, if that's so, then we'll just leave it as it is and see you guys next week, and have a nice day then. Okay, bye.
Thank you, Doctor.
Thank you, Doctor.
All right, thank you. Okay, bye. Okay, thank you.
Thank you, Doctor.
Okay, bye. Yeah.
Thank you, Doctor.
Bye. Bye.
Thank you, Doctor.
Sure, bye.